You know, most people think investing is about intelligence, about being faster, sharper, more informed than everyone else. They believe the smartest person in the room wins. Benjamin Graham didn't, and that single disagreement with the world is what made him immortal in finance. Benjamin Graham was born in 1894, long before stock apps, financial influencers, or 24-hour market news. He lived through booms, crashes, wars, and depressions. He watched fortunes appear overnight and disappear just as fast. And from all of it, he reached a conclusion that still makes people uncomfortable today. Investing has very little to do with being smart, and almost everything to do with being disciplined. Graham didn't speak like a salesman. He didn't promise excitement. In fact, if you listened carefully, his ideas almost sounded boring. And that was the point, because boredom in investing is often a sign that you're doing something right. Early in his career, Graham saw something most people refuse to acknowledge. The market wasn't a machine that calculated truth. It was a crowd, emotional, inconsistent, sometimes rational, often irrational. Prices didn't always reflect value. They reflected fear, greed, hope, and panic. And once you truly understand that, your relationship with money changes forever. Imagine walking into a business partnership where your partner shows up every day with a different mood. One day he's euphoric and insists your business is worth a fortune. The next day he's depressed and wants to sell his share for almost nothing. Graham called this partner Mr. Market, not as a joke, but as a warning. Mr. Market exists to serve you, not guide you. His job is to offer prices, not opinions. The mistake most people make is listening to his emotions instead of using their own judgment. Graham believed the average investor wasn't doomed by lack of opportunity, but by lack of temperament. People didn't fail because they couldn't find good investments. They failed because they couldn't control themselves when things went wrong. During market crashes, Graham noticed a strange pattern. Prices would fall far below what businesses were actually worth. Not because the businesses stopped earning money, but because people panicked. They sold not because it was logical, but because fear became unbearable. And those moments, Graham believed, were not disasters. They were invitations, but only for those prepared to think differently. One of Graham's core ideas was the difference between speculation and investing. To him, investing was not guessing where prices would go next week or next month. Investing was buying a business at a price that made sense, with a margin of safety that protected you if things didn't go as planned. That margin of safety was everything. Life is unpredictable. Businesses fail. Economies slow. Mistakes happen. Graham didn't believe you could eliminate risk. He believed you could manage it. And the way you did that was by refusing to overpay, refusing to chase excitement, and refusing to rely on optimism alone. Most people do the opposite. They buy when confidence is high, prices are inflated, and everyone feels smart. And they sell when confidence is gone, prices are low, and fear dominates the conversation. Graham watched this behavior repeat decade after decade, across generations, across markets. The tragedy wasn't that people lost money. The tragedy was that they never learned why. Graham often emphasized that an investor's worst enemy isn't the market, it's the mirror. Your own impulses, your need for certainty, your discomfort with waiting. These are the forces that quietly destroy long-term wealth. He taught that investing should be approached with humility, not arrogance. You don't need to predict the future. You don't need to be right all the time. You need to avoid being catastrophically wrong. That's why Graham favored companies with strong balance sheets, consistent earnings, and prices that already assumed pessimism. He wanted investments that didn't require perfection to succeed. Ones that could survive bad news, bad timing, and human error. This mindset was revolutionary because it removed ego from the equation. It wasn't about being brilliant. It was about being careful, and careful over time compounds. Graham also understood something deeply psychological. People crave action. They feel uncomfortable doing nothing. Watching markets move without reacting feels irresponsible, even when patience is the smarter choice. So people trade too much, adjust too often, and interfere with their own success. Graham's philosophy demanded restraint, and restraint is rare. He believed that if you approached investing like a business owner instead of a gambler, your results would eventually separate you from the crowd. Not quickly, not dramatically, but steadily. This idea didn't appeal to everyone. In fact, it appealed to very few. But those who understood it didn't just survive the market. They endured it. By the time Graham reached the later years of his life, he had seen enough cycles to know that markets change. But human behavior doesn't. Technology evolves, financial products become more complex, but fear and greed remain exactly the same. That's why his lessons still matter. Because the greatest risk today isn't lack of information. It's too much of it. Noise, opinions, predictions, constant stimulation. All of it pushes investors further away from the calm, rational decision-making Graham believed was essential. He didn't teach people how to get rich fast. He taught them how to avoid getting poor slowly, and that distinction is everything. What most people don't realize is that Graham wasn't trying to make investing exciting. He was trying to make it survivable, sustainable, repeatable. He understood that wealth isn't built in moments of brilliance, but in years of consistency. If you remove emotion, reduce mistakes, and protect yourself from downside, upside takes care of itself. That was Graham's quiet advantage, and most people still ignore it. He also understood that the market rewards behavior, not intelligence. You could have an IQ of 160 and still sabotage yourself financially if you lacked patience. Graham saw this repeatedly. Investors who knew every formula, read every report, followed every trend, yet collapsed under pressure the moment prices moved against them. One of Graham's most uncomfortable truths was this: the market doesn't punish ignorance as much as it punishes overconfidence. People who believed they were smarter than the market took risks they didn't understand. They borrowed money. They concentrated everything into one idea. They ignored downside because optimism felt good. And when reality arrived, it arrived brutally. Graham believed true investing began with accepting uncertainty, not fighting it, not denying it, accepting that you will never have complete information, never perfect timing, never guaranteed outcomes. Once you accept that, you stop trying to be clever and start trying to be safe. That's where his philosophy quietly separated winners from losers. He often warned against forecasting, not because forecasting was useless, but because it gave people a false sense of control. When investors believed they knew what would happen next, they stopped protecting themselves. They built strategies that only worked if everything went right. Graham didn't trust plans that required perfection. Instead, he trusted preparation. Preparation meant buying assets that already reflected bad news. It meant assuming that some of your decisions would be wrong. It meant structuring your finances so that mistakes didn't destroy you. Graham didn't aim to avoid losses completely. He aimed to make losses survivable. This thinking was radical because it ran against human nature. Humans want certainty. They want confidence. They want reassurance that everything will work out. Graham offered none of that. He offered probability, discipline, and time was his greatest ally. He understood compounding in a way most people never emotionally grasp. Not just compounding of money, but compounding of behavior. Small, sensible decisions repeated year after year quietly created enormous results. Not because each decision was extraordinary, but because none of them were destructive. Graham also had a strict view on speculation. He didn't claim speculation was evil. He simply believed it should be labeled honestly. If you're buying something because you expect someone else to pay more for it soon, that's speculation. And speculation is fine, as long as you admit what you're doing and limit the damage it can cause. The danger came when people confused speculation with investing. When they convinced themselves that excitement was intelligence and momentum was value. Graham watched people gamble with their futures while calling it strategy. He refused to participate in that illusion. Instead, he encouraged investors to develop emotional distance from price movements. Price was information, not instruction. A stock falling wasn't a signal to panic. It was a question asking whether value had changed or emotion had taken over. Most people never pause long enough to ask that question. Graham also warned against stories. Humans love narratives. A charismatic CEO, a revolutionary product, a once-in-a-generation opportunity. Stories make investing feel meaningful. They also make people blind. Graham preferred numbers not because they were perfect, but because they were less seductive. He believed that if an investment only made sense when accompanied by a great story, it probably wasn't a great investment. This discipline protected him and his students during times when markets lost their minds. When crowds rushed toward whatever was fashionable, Graham moved slowly or not at all. When prices collapsed and pessimism dominated headlines, he became interested, not because he enjoyed chaos, but because chaos created mispricing. One of the most powerful lessons Graham left behind was this: you are not required to act. Doing nothing is often the most intelligent response. The market offers opportunities constantly, but not all opportunities are good. Waiting was not weakness. Waiting was strategy. This idea is deeply uncomfortable for modern investors, especially in a world where activity is mistaken for progress. Graham rejected that mindset completely. He believed that most money is lost not through bad investments, but through unnecessary action. He also understood that personal finance and investing were deeply connected. You couldn't separate how someone invested from how they lived. Someone who spent everything they earned, chased status, and avoided discomfort would bring those same habits into their portfolio. Graham lived modestly, not because he had to, but because independence mattered more than appearance. Financial freedom to him wasn't about luxury. It was about control. Control over decisions, control over time, control over fear. He believed debt was one of the most underestimated dangers in investing. Debt magnified mistakes. It turned temporary problems into permanent ones. While leverage could accelerate gains, it could also eliminate you entirely. Graham preferred slower growth to irreversible loss. Survival always came first. He often said that the future was unpredictable, but human behavior was not. People would continue to overreact. They would continue to chase trends. They would continue to confuse optimism with safety. And because of that, disciplined investors would always have an advantage. That advantage wasn't speed. It wasn't access. It wasn't intelligence. It was temperament. Graham's students absorbed this lesson deeply. Some applied it quietly, building wealth over decades without attention or drama. Others ignored it, seduced by faster paths and louder promises. The outcomes were rarely surprising. As markets evolved, Graham's ideas were sometimes dismissed as outdated, too conservative, too slow, too cautious. But every major financial crisis brought his principles roaring back into relevance. Because when leverage collapses, when optimism vanishes, when confidence evaporates, only margin of safety remains. Graham understood that wealth is not built by avoiding volatility, but by refusing to let volatility control your decisions. You don't need calm markets to succeed. You need a calm mind. And that, more than any formula, was his real legacy. He didn't promise certainty. He promised resilience. And resilience over time quietly wins. That resilience became most visible near the end of Graham's life, when he reflected on what truly separated successful investors from everyone else. It wasn't access to secret information. It wasn't timing the market. It wasn't brilliance. It was emotional control over very long periods of time. He understood that markets exist to test patience, to tempt people into acting at the worst possible moments, to convince them that what is happening now will last forever. When prices rise, people believe risk has disappeared. When prices fall, they believe opportunity has died. Graham knew both beliefs were illusions. He often reminded investors that volatility is not the enemy. Volatility is the fee you pay for long-term returns. If you demand a smooth ride, the market will eventually remove you. Only those willing to tolerate discomfort are rewarded with compounding. This was especially important for ordinary people. Graham never designed his philosophy for professionals with unlimited resources. He designed it for individuals who couldn't afford catastrophic mistakes: teachers, engineers, doctors, small business owners, people whose futures depended on not blowing up. He believed that investing should protect people from themselves first and from the market second. That's why he emphasized rules, clear boundaries, objective criteria, not to eliminate thinking, but to prevent emotional decisions during stressful moments. Rules kept investors grounded when emotions tried to take control. Graham also believed that freedom came from simplicity. The more complicated your strategy, the more fragile it became. Complex systems broke easily under pressure. Simple systems endured. He didn't chase perfection. He chased durability. As he aged, Graham became even more convinced that financial success was less about maximizing gains and more about minimizing regret. The pain of losing money, he observed, lingered far longer than the joy of making it, and losses early in life often permanently damaged people's willingness to invest at all. So he urged caution not as fear, but as respect for human psychology. One of his most powerful ideas was that the market doesn't care about your needs. It doesn't care if you're saving for retirement, paying for education, or trying to secure your family's future. The market offers prices, nothing more. It's your responsibility to engage wisely. Graham rejected the idea that markets owed anyone success. He believed responsibility rested entirely with the investor, and yet his philosophy was deeply optimistic. Because he believed ordinary people, armed with discipline and patience, could outperform professionals chasing ego and excitement. He believed humility was a competitive advantage. He believed consistency mattered more than brilliance. Perhaps most importantly, he believed that financial independence wasn't about beating others. It was about mastering yourself. As his ideas spread, they influenced generations far beyond his lifetime. Some of his students became famous, others remained invisible. But the philosophy remained the same. Buy value, demand safety, control emotion, and let time do the heavy lifting. Graham understood that money amplifies character. If you are disciplined, money rewards you quietly. If you are reckless, money exposes you mercilessly. That's why his work endures. In a world obsessed with speed, he preached patience. In a culture addicted to prediction, he taught preparation. In markets driven by emotion, he demanded reason. He never promised that investing would be easy. He promised that it would be fair, but only over long periods, and only to those willing to behave differently than the crowd. By the time Benjamin Graham passed away in 1976, markets had changed, but his principles had not, and decades later, they still haven't. Because while technology evolves and instruments change, human behavior remains stubbornly predictable. Fear still causes people to sell low. Greed still causes them to buy high. Overconfidence still convinces them they're different. And impatience still destroys compounding before it has time to work. Graham didn't try to eliminate these forces. He simply taught investors to stop obeying them. His greatest lesson was not about stocks or bonds or balance sheets. It was about temperament, about learning to remain rational when others lose their heads, about resisting the urge to act when action is unnecessary, about understanding that doing nothing at the right time is often the hardest and most profitable decision of all. In the end, Graham believed wealth was built quietly, without drama, without headlines, without applause. It grew through years of sensible choices, reinforced by discipline, protected by margin of safety, and multiplied by time. And perhaps the most powerful part of his philosophy is this: you don't need to be extraordinary to succeed. You need to be consistent. You don't need to predict the future. You need to survive it. That is the timeless wisdom Benjamin Graham left behind. Not a shortcut, not a trick, but a way of thinking strong enough to last a lifetime.